In today's market update, we're going to be taking a look at the S&P 500 again. I'm going to be focusing in on some of the details of the two analyses that we've been looking at in the past two market updates for the S&P 500. We had some great questions on last week's market update, and it made me realize that sometimes I tend to gloss over some of these details in these videos, and so today we're going to take a bit of a deep dive and discuss some of those details so as to clear up any confusion that might have been created by rushing over them in previous videos. So first of all, here is one of the analyses we've been looking at for the S&P 500 recently. I'm not going to go through every single detail because you can simply catch up by watching the past two market updates for the S&P 500. Of course, you can go much further back and take a look at the history of this analysis as it has developed over time. The important thing is that both analyses believe that an important trough occurred in October of last year, probably a trough of 54-month cycle magnitude, maybe only a trough of 18-month magnitude. And if you are new to Hurst cycles, that might sound like a big difference to you. 18 months to 54 months is surely a huge difference. And as discussed in a recent market update, might have been last week, I explained why, although it sounds like a really big difference when you are dealing with a simple single degree of magnitude between possible cycle troughs, it doesn't make a huge difference to the trading decisions that you are making as a result of it. Many people like to achieve absolute certainty in their analysis, and certainty, as I have mentioned, is, I believe, a fairly rare commodity when it comes to analyzing financial markets. The recent discussion has to do with this 40-week cycle trough. We have been anticipating the formation of this 40-week cycle trough. We started discussing it in July, and you can see that in this updated analysis, Sentient Trader has in fact positioned hollow diamonds beneath the trough that occurred on Friday of 2 weeks ago, so about 10 days ago. Why are those diamonds hollow? It is because this trough has not yet been confirmed. In other words, we're expecting a 40-week cycle trough. So far, nothing has denied the possibility that that is a 40-week cycle trough, but neither is it yet confirmed. In the other analysis, we have been considering the possibility that this 40-week cycle trough, and you can see the pin symbol there indicating that I've influenced this analysis, the possibility that this 40-week cycle trough actually did occur in early July. As discussed in last week's market update, all that this does is it changes the potential magnitude of this cycle trough that formed Friday 2 weeks ago. Now, the first detail that I would like to focus on has to do with cycle shapes and bullishness or bearishness. I often speak about cycle shapes because one of the great benefits of performing a cycle analysis is the fact that it enables us to anticipate the kinds of shapes that will form on the market. One of the great benefits of performing a cycle analysis is that it enables us to anticipate the kinds of shapes that will form in the price movement. What do I mean by a shape forming in the price movement? Well, cycles influence prices to form M shapes. Here is a very clear M shape that was formed within this 20-week cycle. Aspects of the cycle shape that we could have anticipated were the fact that it was a bullish cycle shape. How do we define a cycle shape as being bullish? We define it as having a late peak. If the peak in the cycle occurs late in the general progression of that cycle, then that is a bullish cycle. And then, of course, the fact that the trough that forms at the end of the cycle was higher than the trough that formed at the beginning of the cycle. That is, of course, also a bullish cycle shape. Now, one of the reasons that I am still considering this analysis, although I must say the other analysis with the 40-week cycle trough having occurred last week on Friday, or the week before on Friday, that analysis is, in my opinion, the more likely analysis at the moment. But the reason why I continue to consider this analysis is because of the fact that the 40-week 40-week cycle trough occurs almost exactly on time. The average length of the 40-week cycle discovered by Hurst 50 years ago is 272 days. You can see that in the first week of July, or that might be the 10th of July, I think, the 40-week cycle trough or potential 40-week cycle trough would have then occurred 270 days after the trough in the middle of October. In other words, exactly at the average length, or a 2-day difference from the average length discovered 50 years ago. That's pretty extraordinary. Now, if the 40-week cycle trough occurred later, as it possibly did, then that would have given us a length of 308 days. Hurst defined something called the principle of variation that tells us that these cycles are dynamic. Their cycle wavelengths are constantly changing. But the reason that I continue to consider this analysis is because I mentioned in a previous video that when there is a bullish underlying trend, we expect troughs to occur early rather than late. And so this is the first detail that I want to mention. The 40-week cycle trough is expected to form early because according to this analysis, it has a bullish underlying trend. What does that mean? It means that cycles longer than the cycle being considered, and here we are considering the 40-week cycle, cycles longer than the 40-week cycle are pushing upwards according to this analysis. That is true if the 18-month cycle formed a trough in October and also the 54-month cycle trough formed in October, because then both of those longer cycles, and those are pretty long cycles, are pushing upwards. That upward pressure from those longer cycles gives the 40-week cycle a bullish underlying trend. When a cycle has a bullish underlying trend, we can anticipate the fact that the cycle trough will often occur early. It is not an absolute science. Not every single cycle trough in a bullish underlying trend does occur early. Cycles are dynamic, and they are constantly breathing, expanding and contracting. And so we expect an early trough, but that is not absolute proof that the 40-week cycle trough did occur over here in July, but it is certainly a reason to give this analysis some serious consideration. But then in the same video in which I discussed the bullish underlying trend of the 40-week cycle, I also mentioned that if this analysis is correct, with the 40-week cycle trough occurring early in July, then the cycle trough that occurred probably 10 days ago would be expected to be a 40-day cycle trough, as you can see we have on this chart at the moment, and that has bearish implications. The interesting question in the comments to last week's video was, why was I describing a bullish scenario for the 40-week cycle, but now I'm speaking about a bearish situation? And this is a really important detail. It was a great question. Let's zoom in a bit and consider the 40-day cycle and the 80-day cycle here. Bear in mind that each cycle has its own underlying trend, which is the sum of all cycles longer than it. And so the 40-week cycle, as I've mentioned, has a bullish underlying trend. Now, what about the underlying trend of this first 40-day cycle, extending from the middle of July over here until the middle of August? What is the underlying trend of that cycle? The underlying trend, I hope you answered correctly, is still bullish because we have an 80-day, a 20-week and a 40-week cycle pushing upwards. At this point, if the 40-week cycle trough did occur in early July, then in fact the 18-month cycle would have started turning downwards. But that nevertheless gives us a bullish 40-day cycle. And so the underlying trend of this 40-day cycle is bullish. It's not a bearish underlying trend. Why then did I say in my previous video that the next 40-day cycle would be expected to have a bearish cycle shape? And just to be clear, a bearish cycle shape means that we should expect an early peak. In other words, a peak in the cycle that occurs before the midpoint, and it is expected to carry prices to a lower level than the level at which the cycle started. Why did I say that we are expecting a bearish 40-day cycle coming next? The answer to that question does not in fact lie in the underlying trend of this cycle, which I think might have caused some confusion. The answer to why the next 40-day cycle is expected to be more bearish or expected to be less bullish than the first 40-day cycle is because if we take a look at the 80-day cycle, and let me display some circles here. Here is the circle for the 80-day cycle. Remember, these semicircles that are displayed in Sentient Trader are really nothing more than a graphic way of visualizing the path of the cycle. It is not including concepts such as the amplitude of the cycle and so forth. It is simply a graphic representation of where the cycle is expected to be moving up and where the cycle is moving down. Now, within an 80-day cycle, we have two 40-day cycles. One cycle there and a second cycle over here. You'll notice that these points are not completely aligned. The reason for that is because each cycle's wavelength has been calculated, and as you can see in the nest of lows over here, the exact time at which the next trough of each one of those cycles is expected to form is slightly different because of different average wavelengths. But here's the important point, and the reason why I suggested that if this analysis is correct, our next 40-day cycle will be bearish, is because here is the cycle shape that resulted from the first 40-day cycle. We had a strong move up, then we had a very quick move down, then move up to a second peak, and then a move down again. Now, is that a bullish or a bearish cycle shape? Well, of course, it ended at a lower price than the price at which it started, which by definition means that it is a slightly bearish cycle shape. What about the peak? Was the highest peak or the peak of price within that cycle before the midpoint or after the midpoint? Again, it's a close contest between these two peaks, but in fact the true peak or the absolute highest price occurred slightly before the midpoint of this cycle, again pointing to the fact that it is a slightly bearish cycle shape. So regardless of the fact that we should have expected a bullish cycle shape to elapse here because of the fact that the 40-day cycle had a bullish underlying trend, despite that, we had a slightly bearish cycle shape. I'll draw a negative sign, a minus sign, to indicate that it is slightly bearish. It's not very bearish, but it is a slightly bearish cycle shape. Now, for the next 40-day cycle, what do we expect to happen? The only thing that has changed between this cycle over here from the middle of July to the middle of August and the next cycle that will elapse from the middle of August to the middle of September is what? Well, the only thing that has actually changed in the cycle structure is the fact that the 80-day cycle, and we're displaying the 80-day cycle semicircle over here, has turned down. And so for the first 40-day cycle, we experienced a bullish impetus from the 80-day cycle, and in this next 40-day cycle, we are experiencing a bearish impetus from the 80-day cycle. I say it's the only thing that has changed. Of course, all of the other cycles have moved forward in their progression through their cycle phasing, but the dramatic thing that has happened is a switch from a bullish impetus to a bearish impetus of the 80-day cycle. And for that reason, the second 40-day cycle is expected to be less bullish than the first one. As the first one was slightly bearish, I would dare to suggest that the next 40-day cycle, according to this analysis, would then be expected to be more than slightly bearish. In other words, we are expecting a bearish cycle. I hope that that answers that question about the bullishness and bearishness of the cycle shapes, and why, although we do have a bullish underlying trend for the 40-week cycle, we could experience a bearish 40-day cycle. But now let's return to the hot topic of the moment. What is this cycle trough that formed on Friday 2 weeks ago? Was it a 40-day cycle trough, as is shown in this analysis, or was that the 40-week cycle trough, which I've got to say, personally, I think is a little more likely at the moment. In order to answer that question, we need to observe how price reacts to these FLDs. The FLD is, of course, the future line of demarcation, a very important cycle tool that Hurst discovered. It is, in my opinion, a more useful tool than the valid trend line, but that's a subject for a separate video. So let's start with this analysis, which considers that this is the 40-day cycle trough. What would we expect to happen as price bounces out of the 40-day cycle trough in terms of price interacting with these FLDs? Here is the 20-day FLD, and I expect you know that following a 40-day cycle trough, we would expect price to cross above that 20-day FLD. Last week, on Thursday, price came right up to the level of the FLD, as you can see over here, but then it did a very dramatic thing. It immediately turned down again, and you can see we had a strong downward move on the Thursday. Then price went a little lower on Friday and formed a potential trough. As you can see, that is just a little bit above this 10-day cycle trough. That is where we are expecting our first 10-day cycle trough, the average length of which is 7 days. And if you don't understand why the average length of a 10-day cycle trough is actually 7 days, I would encourage you to download the 10 Core Concepts document that there is a link to in the description below this video. But now, here we are on Monday, and I am recording this video, as always, before the markets open in the US, and so we have a little bit of pre-market action, but we don't take that too seriously. But the interesting thing is that because of the way that the FLD is constructed, price has kind of by default crossed over that 20-day FLD. Now, we measure the point at which the median price crosses over that FLD, and I can tell you that that was about over here, and that generates a target where we would expect price to reach as a result of crossing that 20-day FLD. That target is about over here, just below 44.50. So now what does this interaction tell us? Well, following the 40-day cycle trough, as I have already mentioned, we would expect price to cross up above the 20-day FLD. However, the target that has been generated isn't high enough to take us above the 40-day FLD. And as we are expecting, according to this analysis, a bearish cycle shape to elapse, if price reaches the 40-day cycle FLD and finds resistance, then we would pay more attention to the possibility that this is the correct analysis. Where would we then focus? We would then focus on the next two troughs that are expected to form, the 20-day cycle trough and the 80-day cycle trough. Notice the dates for those two troughs. This one is expected early next week, the 3rd or 4th of September, and this one is expected towards the end of September, about the 19th or 20th of September. If we display our composite model line, you will see that we have another way of visualizing what this market is expected to do. A few observations here. First of all, here is the 20-day cycle trough expected in September, on about the 3rd or 4th of September, and here is the 80-day cycle trough expected to form on the 19th or 20th. Now, that is not a bearish cycle shape, that is a bullish cycle shape. Why is that? Well, it's because of the recent 40-week cycle trough. My expectation of a bearish cycle here is based upon the previous 40-day cycle. The composite model line does not include that kind of subtlety in its calculation, which is a good reminder to us to use these tools with discretion and to apply our knowledge and experience to the way in which the tools are actually applied. Another thing to notice here is that, of course, price has recently, as of Thursday, moved away from the more ideal path plotted by the composite model line. As you can see, that might be an indication of bearishness. Bearishness would encourage us to consider this analysis seriously, as I have mentioned, and so we certainly need to keep an eye on it. In our other analysis, with the 40-week cycle trough having only occurred on the Friday of 2 weeks ago, so about 10 days ago, we have a very similar situation with the 20-day FLD. It's not in exactly the same place, because remember, the FLD is plotted according to the recent wavelength of the cycle upon which it is based, and the price cross that so far might potentially have occurred over the weekend is just a little bit higher, giving us a slightly higher projection at about the level of this 40-day cycle FLD. So again, we have the same situation where price crossing the 20-day FLD is expected to take us to the 40-day FLD. At this point, we will be watching very closely to see how the market reacts. Notice the composite model line on this analysis. It is heading off the top of the chart. Let's drag down the top of the chart and see what is actually expected to happen. Why is this presenting a composite model line that is heading off the top of the chart? The answer is very simple. If price is bouncing out of a 40-week cycle trough now, we would expect the bullishness of those cycles as they exert themselves to take the market higher. But notice something interesting about this analysis. We have a trough over here, which is a 20-day cycle trough, exactly as we had it on the other analysis. What is the difference here? This analysis has us expect the 20-day cycle trough occurring 2 or 3 days later, the 5th or 6th of September. And then towards the end of September, we do again have another trough, as is clear in the composite model line. That is a trough of 40-day magnitude as opposed to the 80-day cycle trough in the other analysis. And again, it is occurring a few days later. Why does it occur a few days later? Because the cycles recently, according to this analysis, have been beating with slightly longer wavelengths. And so as price action unfolds, and as we see price interacting with this 40-day cycle FLD and see what it does, is it going to cross up above the 40-day FLD and generate another target to the upside? And as price forms these troughs over here on the 2nd or 3rd or 5th or 6th of September, we will be able to identify the cycle shape that we are seeing for that first 20-day cycle, and we'll be able to determine more clearly which of these analyses is the correct one. Now, it is all very well to watch price action to determine which is the correct analysis on your chart, but if you are trading, what would you be doing here? Well, because there is some uncertainty about the magnitude of this cycle trough, and I should say there isn't a great deal of certainty. Many analysts favor this analysis that we see on the chart now and would laugh at my suggestion that there is uncertainty because they are confident enough in their analysis. But let's assume that you are being cautious and you are aware of the fact that there is some uncertainty around this analysis. Would you have entered as price touched this 20-day FLD? I would suggest that you wouldn't have, or perhaps I should say that you shouldn't have, because we knew that that 20-day FLD was going to provide us with useful information. If that FLD provided resistance, as it did, it increased the chances that we are in a bearish cycle. That has not yet been taken off the table. Now that price has possibly crossed above the FLD, and of course we haven't seen today's price action, the median price of today might end up below the FLD, in which case we do not get a price cross. But again, you would not be sitting here thinking, I'm going to buy at the level of the FLD. What you would do in a situation like this is watch how this cycle shape unfolds. You would wait until price comes down to form this first 20-day cycle trough. We would expect the 20-day cycle trough to find support at the level of the 20-day FLD. If it shows signs of doing that above the level of the 20-day FLD, that will increase our confidence in the bullishness of this market and therefore the fact that the 40-week cycle trough formed on the 18th of August. And at that point we could enter a long trade with some confidence. If, on the other hand, price struggles to get through these FLDs and is still floundering around at about this level or is even lower at this point, then of course we will tend to favor the other analysis. Now, what if you don't want to wait for a full 20-day cycle to elapse after price potentially forms a 40-week cycle trough? I should point out that one 20-day cycle in a 40-week cycle is not really a very long time to wait. We potentially have a good many months of bullish action ahead of us. But if you are not willing to wait that long, then of course you need to be looking at the shorter cycles. you might be wanting to catch the first 10-day cycle trough or the first 5-day cycle trough. In which case, of course, you will need to be looking at shorter time frame data, looking at a 4-hour chart, an hourly chart, or even a 1-minute chart in order to time your entries. I do hope you found this market update useful and interesting. I hope that this detailed video cleared up some of the misunderstandings or confusions around the concepts of bullishness and bearishness and cycle shapes, and also how we can clearly understand what is happening when there is some uncertainty in the analysis. If you have any questions, please put them in the comments below this video or join us on our Discord server. I look forward to hearing from you.